As you see here, over the past couple months, the S&P 500 has been down about 6.5%. The NASDAQ is down over 11.5%. And the Dow is down over 4%. However, in my outright stock ownership account, we're actually up over 3.3%. And then over the past 3 months, it's more of the same thing. Our account is up and the indexes are all down. And this repeats itself on every time frame over the past couple years. On every time frame, we've beaten the overall market. And we're not using any kind of leverage or margin. This is a cash-based account. And as some of you know, I like to trade options. We haven't traded a single option in this outright stock ownership account. We have simply been buying and selling stocks outright. In this video, I'm going to show you the very simple strategy I've used to consistently beat the market over the past several years. My name is Randy Perez. I'm a 20+ year stock and option trader. There's a popular belief that you should just buy the S&P 500 or the SPY ETF and then just forget about it. And for people that don't have the time or the desire to learn about the markets, that can be an okay way to invest. But if you're willing to spend a little bit of time picking stocks and getting an education to help you to pick the proper stocks, I believe over the long run, you actually will beat the market. You can do it with less volatility or less risk. Let me show you how I've done it. I'm going to share with you the details of what's happened in the market as well as this outright stock ownership account over the past couple of years. The goal is to help you see my very simple strategy that you can implement to also beat the market long term. At the very end of the video, I'm going to show you where you can potentially find undervalued stocks that you can research further to see if they're ones that you should invest in. Let's first set your baseline foundation for the overall markets. We're going to do this using SPY or the S&P 500. I've drawn 2 lines here for you. Based on the S&P 500's current valuation, this is where it should be trading at because of historic levels. Notice this purplish blue line. I hope that's what it looks like to you because I've been told I'm colorblind, but this purplish blue line here, that's what the market should be trading at based on its 20-year average. Over the past 20 years, the S&P 500's average P to E is 19.8. If it traded at its normal valuation of around 19.8 P to E, this should be trading for around $483 per share. Notice on Friday it closed out at $564 per share, so it's trading for quite a bit more than its 20-year average. What about the past 10 years? We could say AI is really going to present some opportunities, so I think it should be trading for a higher valuation. And that's what's happened over the past 10 years. Notice over the past 10 years, the average P to E is around 21.5. But even when you consider that higher P to E, we're still trading at a little bit of a premium even after the recent decline. Notice that even after the recent decline, the S&P 500 is still trading at about a 5% overvaluation based on its 10-year P to E. So I think we get this, and you've probably heard this all over the internet. The S&P 500 is expensive, and people are saying, well, it's expensive because we have AI that's going to improve margins. And AI very well may do that. But I'm looking at the facts here. The 20-year average is 19.8 P to E. The 10-year average is 21.5 P to E. We're trading above both of those right now in the stock market. In just a minute, I'm going to give you the details of exactly what I've been doing that's enabled me to beat the market. But I first want to give you an overview of the market compared to my outright stock ownership account. This account is worth just over $100,000. It's an account I've been adding money to over the past couple years. And here you see the returns of this account against the popular indexes. You see in this account, we're up right at 13.4%. The S&P 500 is up 9%. The NASDAQ is up 9%. And the Dow is up 6.5%. So notice we've more than doubled the return of the Dow. If you run some quick math here, you'll see this account, which is just owning stocks. We're not trading any options. We're not using any kind of marginal leverage. This is just outright stock ownership. We're beating the NASDAQ by over 44%. And the S&P 500, how's it fared against our return? Well, we've beaten the S&P 500 by almost 50%. See, we're beating it by 48.6%. So the question is, how do we do it? Or more importantly, how can you do it? And I'm going to tell you, you can do it. So here's how I've done it. Now, I don't want to overwhelm you here. My goal is to make it simple for you. And I'm going to tell you how you can hit the easy button at the end of this video. But let me briefly share with you the metrics that I track and I watch on the companies that I trade in. Again, don't get overwhelmed. It's going to be easy for you in just a minute. But I want you to have an understanding of what I'm doing here. So the metrics I watch are as follows. The adjusted operating earnings, the basic earnings, the diluted earnings, operating cash flow, free cash flow to equity, EBITDA, EBIT, and price to sales. All right, that's it. Now we're going to make it simple for you. What does all that mean? I watch all those metrics and I see how the price of the stock is acting against those metrics. As long as the company is showing good future prospects that's going to grow and those metrics all check out good, I'm buying that company. Now there is one little caveat there. I'm only buying that company if I believe that it is undervalued or has the tremendous opportunity to grow in the future. Now I'm a visual person, probably a lot of you are visual also. So what I just said probably like went right over your head. So let me show you what I mean. I'm going to show you using 2 positions I closed out this past year. And these are in boring, mature companies. I want you to see how you can trade in boring, mature companies and still beat the market long term. Here you see the details of the 2 positions I'm going to talk through in this video. I'm first going to show you this information here on an Excel sheet, and then I'm going to take you to the charts because I think it'll help you to understand what exactly I've been doing. So overall, in a nutshell, here are the 2 companies that I closed out I want to share with you in this video. One of them is boring old AT&T, and the other one is Cisco. Let's take AT&T first. Notice I was buying this stock starting in 2020, then I bought more in 21, 22, 23, and 24. And then over the past several months, I liquidated this position because I believed AT&T had reached its full value, so I wasn't interested anymore. I want undervalued companies. And AT&T was fairly valued. So at that point, I wanted to sell my AT&T stock to someone who wants it at fair value, in my opinion. So what was our return? Well, remember, I like to keep my position sizes small. I don't want any one position to be more than 5% of my overall portfolio. This account has just over $100,000 in it. So this was a smaller position. And notice these 2 columns over here. First is days in position. That's how long we owned those shares of the stock. Then this is the column here that's of most interest to me and probably to you, is the annualized return. How much did I make on those shares of AT&T or on those shares of Cisco? So notice that going back to 2020, I really didn't make anything on those shares. They kind of were dead money to me. But then as AT&T continues to decline and I bought more shares, then my nice return started to kick in. Remember, this is the annualized return column. This isn't overall return, it's annualized. So as AT&T dropped and I bought more, notice that in the end, I ended up with a 29% annualized cash on cash return. That's non-leverage. I just bought the stock when it was cheap and I sold it when it was expensive. Overall, it was a 29% annualized return on AT&T stock. That's a boring old stock. We still got an awesome return. Why? Because we bought it when it was undervalued and we sold it when it was fairly valued. Before I share with you the charts to show you how you can do this for yourself, let me share with you the other position I'm going to talk about, and that's Cisco. We see those numbers down here. So Cisco, I bought it between the years 2021, 2022, and 2023. Bought a little bit there at the beginning of 24, as you see there. Again, a smaller position size. But notice how long we own these shares. See, on average, it was 765 days that we owned these shares. And AT&T, it was on average 818 days. That's how long it took for AT&T to kind of bottom out and then reach its fair value, in my opinion. And this 765 days on average, well, that's how long it took Cisco to kind of bottom out, level off. Then the market realized, hey, this is a good opportunity. So then it returned to fair value. And what was my overall return with Cisco? Well, not as good as AT&T, but still decent. Still beat the market, and it beat it by quite a bit percentage-wise. But the average return was 14%, as you see here. We had one tiny little purchase here. I think that was a dividend reinvestment that we actually lost money on. For the rest of them, realized a nice positive annualized return. Remember, all we're doing is buying the stock when it's cheap and selling it when it's expensive. This might also be a little reminder why I don't really do drip. I like to reinvest my capital myself in undervalued companies, and that's why I don't do drip. I know some of you have asked me about drip, and personally, I don't drip stock. I like to redeploy that capital as I see fit in undervalued companies. So there's the details. You see the actual returns. Let me show you how you do this using a chart. So I've kind of zoomed out and taken you back in time to our AT&T stock here, and this box is the time frame that I was buying AT&T. So notice what's going on here. I've put a couple of numbers that are important to you if you're going to do the same thing. So the lifetime P/E of AT&T is about 12.22 price to earnings. Up in here, it was trading for around 9 price to earnings. Down in here, it got down to a 7 P/E, and right in here, it was at 5.85 P/E. This is the time frame I was buying AT&T stock at. Now, like you, I could have bought it back in here, but it was too expensive. And if I slide over here, you see that AT&T, after I was buying it, it began to take off and slowly ground higher. Here, more recently, it's been trading at a 12 P/E. Well, in my opinion, that's fair value. I don't want to buy shares of a stock when it's trading at fair value. I want to get a deal. And you're probably the same way. So what did I do? Well, I sold it to somebody else who was okay buying it at fair value. Remember I mentioned the strategy is simple? It is simple. You buy it when a stock is cheap and you sell it over here when it gets expensive. Now, it might take some time because remember, we're in these trades for 700 to 800 days, but the annualized return, it was still really good. All right, now let's look at Cisco. And Cisco is more interesting in my opinion because throughout the time that we were trading it, there were times where it was expensive and there were times where it was cheap. So we simply ignored it when it was expensive and we bought it when it was cheap. Let me show you what I mean. So this white box, this is the time frame that we are buying Cisco stock in. Now I have some notes for you up here. The lifetime P/E of Cisco is just over 15. It's 15.14. In this area in here, back in January 22, it was trading for a 19 P/E. Too expensive. You see? It normally trades at a 15 over its lifetime. It was at a 19. I would have been selling there. I definitely would not have been buying there. And you see my note for you here that we bought on average at $48.37 per share. So this yellow line here, that was the average of what we paid for the stock. We bought some down in here when it was trading at an 11.6 P to E. We probably bought some up in this area in here. But overall, our average was at $48.37 per share. So we bought it when it was cheap. We ignored it when it was expensive. And when it got real expensive, well, I sold it. Now we're back up to an expensive valuation. It's at $60.41 per share. So am I buying? No, I'm not buying. But I'd love to buy some when it comes back down this area and trading at an undervalued valuation. If you've been watching my channel for a while, you know I love trading options, but they require weekly monitoring and maintenance. But what I really love is just simply buying stocks where the companies are undervalued and holding them. And if they are dividend paying stocks, collect those dividends and wait for them to become fairly or overvalued and then sell them. It's that simple. As you saw, you don't have to do that many transactions to have a really nice annualized return. Every weekend, I review the fundamentals of the over 250 stocks that I'm willing to trade in. I'm looking for opportunities when I can buy them and they're undervalued. I then buy them outright and I wait for them to become fairly overvalued and I sell them. And I don't keep this list all for myself. I share it with my patrons. So if you'd like to get this list every weekend, consider the benefits of becoming a patron down at the link in the description below. If you'd like to see 5 reasons why you should consider buying stocks over ETFs, check out the video at the link above and the description below entitled The Shocking Truth About ETFs versus Single Stocks. Until next time, happy investing, and we'll see you again soon.